Hi there. I'm Jason Ayers, founder and president of OptionSource.net, and thank you for joining us to learn about selling call options. Many investors sell call options to generate income or profit from range-bound or even slightly bearish stocks. Selling call options may also be used as an exit strategy for a stock position with a specific target or to hedge the immediate downside risk on shares being held in a portfolio. Selling calls while owning the obligated shares is referred to as being covered. The covered call writer is obligated to sell the shares to the option buyer at the strike price of the call sold. The risk in this strategy is associated with stock ownership. In-the-money option premiums are made up of both intrinsic and time value. It is the intrinsic value of the option that provides the covered call writer with increased downside protection. The deeper in the money the strike price of the option sold, the greater the downside protection for the investor. An option is considered to be at the money when the stock price is equal to the strike price. These options are made up entirely of time premium and offer the investor the greatest return if the stock does nothing within the expiration time frame. This is also referred to as static return. Writing out of the money call options allows the investor to profit from an upside move in the underlying security. The out of the money covered call writer collects a smaller premium but allows for greater profit if the stock moves higher. With XYZ trading at $50 per share, a 2-month call option at the 50 strike may be listed at $2.50. The investor may purchase or already own 1,000 shares of XYZ. At the same time, the investor sells 10 call options and collects $2,500 in premium up front. On expiration, if the shares are trading anywhere above the sold strike price of $50, the covered call writer will deliver the shares and keep the entire premium collected. Notice that the covered call writer cannot profit anywhere above the sold strike, limiting the profitability to the premium collected. However, if the share value drops, the covered call writer may still profit. By selling the call option, the investor has lowered the cost base of the shares by the amount of the premium. In this scenario, by paying $50 per share and collecting $2.50 in premium, the break-even point is reduced to $47.50. The investor will still profit as long as the share value remains above this point. In this comparison, notice that the at-the-money right would produce the greatest rate of return if the stock remained at the same value over the 2-month time frame. The in-the-money option offers greater downside protection but limits the rate of return. This might be appropriate when the investor believes that the stock may experience a drop in share value over a certain period of time. The out-of-the-money option right results in less return as well as limited downside protection, but is effective if the investor believes that an increase in share value is expected over the 2-month time period. We can now see how covered call writing can be used to generate consistent cash flow in a portfolio. By selecting the at-the-money call, the investor has created $2,500 or 5.26% in real cash flow over a 2-month period and has reduced the cost base of the investment. The potential income is greatly influenced by the strike price selected. In exchange for the cash flow, the covered call writer gives up profiting on share ownership above the $50 strike price. A covered call may also be used as an exit strategy to sell the underlying shares at a price above the current share value. The investor may have an established price target for shares being held long and choose to write a call option close to that target. This immediately reduces the cost base of the investment while waiting for the share value to appreciate. One disadvantage of this approach is that the investor has less flexibility in making adjustments once the exit strategy has been put in place. If the investor anticipates market weakness or very little upside on a stock position over a period of time, a call option may be written to reduce the cost base of the shares. The deeper in the money the strike price of the written call, the more intrinsic value is captured, resulting in an increased hedge to the downside. The covered call strategy has the identical risk-reward distribution as selling a put option. Expressed another way, being long the stock and short a call option is equal to being short a put on the underlying security. The put writer does not own the shares but collects a premium for taking on the obligation to purchase them. As the share value drops below the sold strike, the put writer incurs a loss comparable to owning the underlying. This loss is offset by the premium collected, but is undefined as the share value drops. This risk graph reflects the limited profit potential of both the short put and the covered call position. Note that in both strategies, the risk is undefined as the share value decreases below the break-even point. Call options that are sold without the investor holding the obligated shares are referred to as being naked. Despite not owning the shares, the call option seller or writer is still obligated to deliver them if the stock is trading above the sold strike price within the specified time frame. This creates an undefined risk as the call writer may be forced to purchase the obligated shares at a significantly higher market price and deliver or sell them at the lower strike price. The risk of loss for the naked call option is similar to that of short selling a stock. If XYZ is trading at $50 per share, a 2-month call option at the 52 strike price may be trading at $2 per contract. Remember that each contract controls 100 shares. Therefore, each call value is $200. The investor may sell 10 call options collecting $2,000 in premium up front. In this scenario, the call writer does not own the shares and is considered to be naked. In other words, the naked call writer has created an obligation to deliver or sell 1,000 shares of XYZ at $52 within the specified time frame, regardless of how high the shares trade above the strike price. If the share value remains below the sold strike price of $52 until expiration, the options will expire worthless and the naked call writer will keep the entire premium. Note that the maximum profit for the call writer is the premium collected. As the share value of the underlying rises, the call premium begins to appreciate and the call writer begins to incur a loss. The break-even point is determined by adding the premium to the sold strike price. As the share value rises beyond the break-even point, the call option writer continues to incur losses. Without owning the obligated shares, the call writer has to buy them at the market price and deliver them at the lower strike. It is important to note that the call writer may buy back the short calls before expiration to eliminate the obligation. However, the loss will still be incurred as the call premium will have increased to reflect the change in the underlying shares. A naked call option has the identical risk-reward distribution as covered put writing on a short stock position. This risk graph reflects the limited profit potential of both the short call and the short stock combined with the short put position. Note that in both strategies, the risk is undefined as the share value rises. An investor may short the stock and sell a put with an at-the-money strike price to collect the premium. As the share value drops, the profit is limited to the premium collected, comparable to the short call position. If the share value rises, the short seller has an undefined risk and is responsible for covering at the market value. Upon covering the position, the loss is determined by subtracting the put premium collected from the difference between the price at which the shares were shorted and the price at which the position was covered.